What people end up doing in their returns is they chase yields. 15, 24 months from now, if interest rates fall, bonds are going to look really, really attractive.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
All right, this is going to be fixed income lessons, understanding the dynamics of volatility in different bonds. This is a core lesson that I want people to learn. This is John Smallwood, and I am back on Money Isn't. This is something today that I feel that people really need to understand how this works in the fixed income environments, right? JP Morgan put out a great chart that I'm going to use in the presentation. So there are visuals. If you're listening to this, you can see it, but I'm going to talk colorfully so that I get as much detail as I possibly can, right? But we're sitting here looking at the fixed income and markets. We're looking at bonds, right? So you have 2-year bonds, 5-year bonds, you have TIPS, 10-year, 30-year bonds. You have different indexes, the U.S. aggregate index, the corporate index, convertibles, high yield indexes, municipals, all kinds of different bonds, right? But bonds work on the same principle. And the principle is this, right? Is if I buy a bond for $10,000 and I get a 5% coupon, and I get $500 of interest from whoever I bought the bond from, whether it's a municipal bond or a corporate bond or a high yield bond, right? Which is a corporate bond. Or a government bond, 20 years later, let's say it's a 20-year bond, I'm going to get my $10,000 of principal back. So I'm buying it for the interest, okay? Along that 20-year timeline, the current interest rate environment is going to change. Let's say that I bought the bond 2 years ago at 3%, and current rates are at 5%. If I want to sell my bond, I have to discount my bond to make it as attractive as a 5% bond. So why would I buy your bond when I can go buy somebody else's bond at 5%, right? So my yield on the bond needs to be the same as current. So visually, I want you to think about this for a second. As interest rates decline, the value of higher interest rates bonds goes up. And as interest rates rise, the value of bonds will fall. Now, there's a thing called maturity. So if I'm 20 years away, the swings are going to be bigger. If I'm only 2 years away, the swings are going to be smaller. And a great visual is if you visualize for a second a seesaw in the backyard, right? And you visualize it, you got the fulcrum in the center and 2 kids are on the outside. One goes up, one goes down, right? So picture interest rates on my left side, price of the bond on my right side. If they're at parity, they're going to stay level, but interest rates, the left side is now falling. The value of the bond is going up, right? So in 1982, if I bought a 17% bond and rates are now 10, that's a pretty valuable bond. It's going to be like, what am I willing to pay for a 17% bond? New rates are 10. I can't go get 10. I want the 17. So it's going to be worth more than $10,000 that I paid for it, right? But as I come closer to my shoulders, closer to the fulcrum of the bond, there's less swings in the volatility, okay? So what I wanted to talk about is we're at a point where the Fed is finally saying we're going to lower interest rates. How much, when? Nobody knows, right? But I want you to understand what happened when interest rates were at like 0.5% on the 10-year treasury, and all of a sudden they went up to almost 5, right? That became the Barclays aggregate index had an 11% down year because they went up so quickly, all right? Because every single day on your brokerage statement, on your online portal, the bonds need to be marked to market. Yes, if I hold the bond to maturity, I'll get back my money, so I don't take the loss until I realize the loss, right? But now, if I'm getting 5% on my money and I can get 7%, I now have an opportunity cost. All right. So what I want you to focus on here is if I look at the 30-year bond for a second, and the chart is basically saying, what is the impact of a 1% rise or fall in interest rates on the value of that bond? So if I'm looking at the 30-year bond and the interest rates rise 1%, that bond falls 12.7%. Conversely, if the interest rates go down 1%, it goes up 21% in value. If I look at the 10-year, interest rates rise 1% from here, that bond's going to fall by 4.3%. It's going to go up 12% if they go down 1%. Now, currently, the 10-year Treasury, according to this document that was printed out as of August 31st, was 3.91. It's 375 this morning when I was doing this. December 31st, it was 4.2 for a 2-year bond. I mistake. The 10-year and the 2-year were identical, which they haven't been like that. So the 10-year was 3.9. It's actually 3.8. I didn't see where the 2-year is this morning when I was recording this. But what I have to understand is interest rates are overvalued at this point. The Fed funds rate, as we did a different podcast, was at this high level. Currently, as I'm recording this, it's at 5.3. And everybody's saying that we need to bring that down below the 10-year Treasury, which is at 3.8. And typically, historically, in a different chart that I showed, it's 1% lower than that. So that means that should be at 2.8. So there's a massive opportunity that we could see bonds, interest rates falling by quite a substantial number over time. Now, the Fed's funds rate falling that way won't have a direct correlation to the bond markets. It'll be different with different maturities in different areas. But you have to think about is what people end up doing in their returns is they chase yields, right? They chase returns. So we look at something 15, 24 months from now, if interest rates fall, bonds are going to look really, really attractive. Rear view mirror in hindsight, because they will have had this return because interest rates went down. If interest rates stay the same, there'll be the coupon returns. If interest rates go up, they'll be negative, okay? So my takeaway is typically in a portfolio, you own bonds to buffer the volatility and to generate some income. That's really the role of a bond. It's buffer the volatility and generate some income. But if I look at this and say interest rates come back down into a reasonable number 10 years from now, where do I think interest rates will be? Will the trend be low forever, or will the trend be a rising back up to the 4 or 5% range? And if it's rising over the next 10-year period, that means the price of the bonds are actually falling and inflation is being impactful at a greater rate on those bonds, right? So the lesson that I want you to understand is in your asset allocation, bonds are not necessarily going to give you the defense if the Fed does the lowering the interest rates, which I believe the 10-year Treasury believes that is priced as if one has already happened. So you might hear the Fed lower interest rates and the bond market do nothing, right? Or the bond might react. If they don't lower it the way they thought, it might actually move back up. But with this is coming a reduction potentially in interest rates, in mortgage rates, in CD rates, in money market rates. So there's always a ripple effect that's going on in the plan. And I want you to focus on what am I doing with the bonds? What are the role? What are things that I could be repositioning into to, do I go longer maturities in this? Do I go shorter maturities? Do I, wait for it to fall and go into a different asset class? Do I chase the yield and go, oh, bonds are up. Let's say the interest rates fall 1% and my 10-year bond fund's up 12%. Do I buy that then? Hoping that it's going to repeat itself? Probably not. Could be part of your asset allocation where you're adding money and you're saying, yes, I'm okay with it. But you have to have a plan. You have to know how this is going to impact your your plan, and that my purpose and my goal today was simply to get this conversation out, to give you some visuals of how the bonds move. You can actually go to JP Morgan Guide to Retirement and download the same deck. It's free. It's available, right? It's out there. But the planning on how you're going to defend your portfolio in short-term volatility and long-term volatility, and how you're going to generate retirement income is going to be one of the most important parts here. Because if I have $1 million in bonds and it's making 3%, 3.5%, that's $30,000 per year. Not that exciting, right? I need to look at ways to generate more income than what I'm actually getting in certain places, right? But without increasing risk. So in the conversation of this, the key is, do I understand what kind of bonds do I own, that I own? What are the role that these bonds are playing in my plan? Is it appropriate in my plan? Can I deploy these assets into other things to generate more future retirement income and reduce my bond exposure potentially, or maintain it? It really comes down to the individual and how the individual has planned their plan and how much withdrawal they need to take from their money to meet their lifestyle. Some people need only a 2 or 3%. Other people need 7 or 8. That's a planning issue, right? So the lesson today is interest rates fall, the value of the bonds are going to go up. Interest rates rise, the value is going to go down. And what we expect is that it's going to be an up and down and an up and down like it's been for the last whole bunch of years, right? It's been like that. I have a chart that was out that I did that showed the volatility, and there's a moment in every single calendar year where the bond market had a negative year at some point. It ended positive in most of them, right? But the idea is it's the volatility that you're trying to reduce in your plan, and it's the predictability of the income that you're trying to generate. And the point is, it may or may not be the right thing in your plan, okay? You need to understand what your impact is going to be, how inflation, planned obsolescence, technological change, all those fuzzy, feely things that are impacting you. Hopefully you found this of value, right? Whether or not you did or not, you should get with an advisor and really understand what's in my plan. What do I own? How will rising interest rates impact this portfolio? How will declining interest rates impact my portfolio? When interest rates decline, what should I do? That's the power. Talk to you soon. Thank you.